Hi, welcome to Financial Thought Exchange, brought to you by the CFA Institute Research Foundation. I'm Larry Siegel, your host today, and I'm the Director of Research at that organization. And our guest today is Professor Will Goetzmann, who is at the Yale School of Management. He is also the executive editor of the Financial Analysts Journal and the author of many books, one of which will be the focus of our conversation today. Will, how are you today?
I'm great. How are you, Larry?
I'm just happy to be able to do this from home, so I don't have to fly to New York or New Haven. We're all saving energy, but it's also nice to be able to network with anybody in the world this way. I wanted to turn to the book that you wrote called Money Changes Everything. It certainly does. But it's actually a book about financing civilization, which is something that apparently goes back to ancient times, maybe prehistoric times for all we know. And when you were talking about writing this book a couple of decades ago, you wanted to call it Financing Civilization, which I thought was a great title because it tells you exactly what to expect in the book. Money Changes Everything being a little more catchy. But I don't think most people understand that civilization needs to be financed. Can you expand on that thought?
Yeah, sure. Well, first of all, the story of the book title is definitely one that evolved. And you're right. The theme of the book is the relationship between finance and complex society. But the title turned towards something that had to use the word money in it because everybody's sort of visceral reaction. Everybody has a visceral reaction to the word money. Very few people really have a visceral reaction to finance, or if they do, it's not a positive one. So hence the title change. But the theme of the book is about finance as a technology, a tool for doing things. And it could be a tool in the hands of the government, in the hands of individuals, in the hands of corporations. But finance is a way of shifting value through time. And when you do that, you can do miraculous things like you could buy a house if you don't have the money on hand. You could build a railroad just by issuing bonds, by borrowing money from a lot of people and promising to pay them more in the future. So it's a way of concentrating value to get things done. But it's also a way of shifting value into the future. So all of us think about retirement one way or the other and often save for it. You couldn't do that without finance. You have to have a tool, a technology for passing money into the future. So financing civilization is really about the theme of how societies use this time machine in order to do things that couldn't otherwise be done. And so the book traces that history from earliest historical records in ancient Mesopotamia in the Middle East to modern times.
Well, it sounds like you're a financial archaeologist. Was it you who said that you were one, or did somebody else come up with that?
I have been called that, and I love the name because I began my whole professional career as an archaeologist. I worked through the summers in high school and college, excavating ancient sites, working on digs, and I really thought that I was going to be an archaeologist until some years after. And hence a really strong interest in the development of humankind and the long-term picture of how societies evolve. And so I just love working with data. I love finding things. So as an archaeologist, one of the thrills is to find things that nobody else had noticed before dig them up, think about what they mean, develop theories about how people use them. Finding a fragment of a pot and imagining what the whole thing looked like and who made it and how it was, how it was used. So think about that in the context of financial information. I got curious about the origins of financial markets. Where did stocks and bonds come from? Who first used them? Who had the idea for them? And also, I got interested in seeing if I could find in the archival records, in libraries and bureaucratic offices and so forth, find records of trading of securities, stocks and bonds and so forth. And so early on in my career, I began to collect data and use data that other people had collected and try and look at the very long-term development of securities markets and investments and so forth.
I was going to ask before you kind of answered the question. Archaeologists go on digs. What does one of your digs look like? I think you go to the library and you go to exchanges, government offices.
Oh, yeah, absolutely. So when I was a graduate student, of course, at that time, the tools of a finance professor are statistics, gathering electronic data, stuff that's already been digitized and analyzing it. But I spent time in the rare book library at Yale called the Beinecke Library. And I found some volumes that were records of the New York Stock Exchange, prices that had been preserved in I guess you'd think about it as newspapers that were used by financiers back in the early 1900s and so forth. And so that became a source. So I hired some people to type in those numbers about the early stocks that traded on the New York Stock Exchange. And that began an attempt to push the history of the American capital markets back in time and see what was going on and what were people investing in.
What were they investing in?
In New York, it was interesting. Banks, insurance companies. It took a while before railroads came into the picture. New York must have been really a financial center because the banks, like I said, were raising money to make loans, and insurance companies were there to write insurance policies about fires that might be happening or maritime or shipping and so forth. So that seemed to dominate the early New York Stock Exchange from at least from the corporate perspective.
Well, railroads had to be invented first. I believe 1820 is the date of the first actual operating railroad, and it was in England. So the New York Stock Exchange had already been there for about 3 decades, hadn't it?
Yeah, absolutely. It's there were informal trades in the late 1700s in Philadelphia, certainly probably in Boston and New York. I'm not sure everybody gathered under a big tree to make trades. They were probably they were sitting in coffee houses where they could get some caffeine in their system to get them excited about making trades. But you're
saying the buttonwood tree is a myth? How did it start? I mean, we learned about the Buttonwood Agreement probably in 4th grade.
Yeah, well, there was almost certainly a buttonwood tree, and it was a landmark that people could refer to. Mm-hmm. But I don't think stock traders set up their tables underneath the shade of a tree as a regular course. But the Buttonwood Tree Agreement was a fascinating agreement. That's typically thought of as a document that launched the New York Stock Exchange. But it was an agreement amongst brokers that they would trade with each other. And that seems, what's exciting about that? Well, if you don't have a system of trust where you could trust your counterparty to actually pay you when you transferred the stock to them, then you've got a mess. Nobody will want to trade. So this Buttonwood Agreement said, okay, we're a small group of brokers. We trust each other. When we make a trade, we will record it in a book and say, I owe so-and-so this much money for those number of shares of stock. What's cool is actually the New York Stock Exchange has an archive. And in the archive, they have some of the early books about people making those notes, brokers making those promises to deliver to each other. And they're handwritten, slightly informal, but you can really almost feel like you're looking over their shoulder when they were quickly saying, okay, we're going to do this deal, and then move on to the next. And then it was preserved so that people could refer back to it if somebody said, oh, you only delivered me 2 shares when you should have been 3.
Well, you're putting a very positive light on what I kind of thought was negative, which is if brokers say that a group of brokers say we're only going to trade with each other, then you can raise prices above the competitive price and have some sort of a monopoly, which is how I think a stock exchange is anyway. They provide a service to the investor because you can find your counterparty there. Instead of over-the-counter trading, you sell your stock to a broker, and the broker, then sells it to some other person. And that sounds pretty inefficient compared to a face-to-face meeting on the floor of an exchange. But the exchanges also kept commissions high, didn't they?
That's almost certainly true.
Was it a fair price for the service of trade matching that they were providing?
Well, that one's a hard thing to test, but we do know that in modern times, let's say over the last 20, 30 years or so, in different locations, London being one of them, but the New York Stock Exchange being another, attempts to break down the power of a cartel to set prices has been occurring, and this modernization of finance that is associated with that freedom to trade has certainly reduced trading costs quite a bit, I would say.
Well, these days trading costs are extremely low. Mm-hmm. But I think back to my youth, they were high, and there was a series of events. One was called May Day in 1975. But if you want to get into that, that's fine. But I actually wanted to steer us back to ancient Rome or even earlier. The only place that I've actually been where you found a stock exchange was in the Roman Forum. It was the temple of, who was it? Apollo?
I think it's a temple of Romulus, I believe.
Okay.
Yeah.
3 columns. Everybody has seen it. Who's seen a picture of the Roman Forum or goes to the movies, visits Rome. What was going on there, and what was so interesting about it?
Well, so that's not research I did. It was research done by a financial economist, Ulrike Malmendier, who now is fairly well known as a behavioral finance professor. But she did her law thesis in Germany about the economics of this interesting Roman institution called publican societies. So publican societies were, you could think of them as big partnerships that had, hundreds of partners who were investors. And the thing that got me interested in it was, well, first of all, these were likely some of the first equity securities that were traded actively. We know that they were that the prices were known and observed, and people had interest in the prices of these equity securities for these publican societies. So what did they do? Well, they were companies that were created to that did work for the government in different ways. So Rome Rome during the Republican period before Imperial Rome, it had grown very quickly through a series of wars, the wars with Carthage and expansion rapidly beyond the Italian peninsula. And so that growth, it turns out it was efficient to well, who knows whether it's efficient, but Rome privatized a lot of operations you might think that the government would be in charge of, supplying food to armies, collecting taxes, repairing and building buildings. These functions were farmed out to these private companies that were partnerships that mostly the investors in the knight class, or you would say the kind of upper class wealthy families had these shares. So in order to feel like the allocation of these contracts was fair, let's say the contract to repair the temples in the Forum would be auctioned on the steps of a temple right in the middle of the Forum, and this is also where people presumably went to trade their shares as well. So this idea of transparency in government allocation of contracts goes all the way back to ancient Rome, as well as this idea that, you need a way of attracting capital to solve big problems, infrastructure problems, and so forth. And what I also argue in my book is that this was a way for the Republican government of Rome to share the wealth, if you will, of this great expansion beyond its early borders. So you can think of the right to collect taxes in Asia Minor, for example, as one of the spoils of war once Rome conquered it. And that's why. So that was, was an interesting deal that they had.
Isn't that why most conquests have taken place in the first place, is to basically to take the tax money from some other group of people? Because it's hard for a country to get rich without seizing other people's wealth if there's no internal self-sustaining capitalism going on within the country. Now, I know Rome had a form of capitalism, but didn't a lot of the wealth of Rome come from exacting tribute or tax money from the non-Italian parts of the Roman Empire?
Well, they certainly exacted tribute. And when I think farther back in time, let's say Athens also extracted tribute. But I think I'm going to quibble with you on the proposition that tribute was one of the main sources of wealth in these early societies, because let's take a society like the Netherlands in the 1500s, in the 1600s. Okay, it's a tiny country. It's not like they had a lot of export to do. But it was a trading nation, and it had a level of freedom of ideas and so forth that attracted people. But it also had capital markets. So you could become a wealthy country by becoming a finance center that would attract people from other places. And it's funny that finance being so dematerialized and hard for people to imagine how it could actually create value. But when there's a need to transfer value through time and insure things, and countries needed to borrow, and you needed expertise about how to actually form these contracts and make sure you weren't going to get ripped off. A culture, a technology of finance, and a culture built around maintaining that actually can create value in and of itself. The earliest example of this is Athens, because people that have gone there, you think of the Parthenon, beautiful temple and so forth. Well, one of the early strengths of Athens was that it had a merchant court where if you invested money with somebody and they cheated you, you could take them to court. And you didn't have to be an Athenian citizen to do that. You could be somebody from Asia Minor or Sicily, or you name it, Mediterranean world. And so those tools of finance, that ability to protect your rights with a legal structure, created value in Athens and attracted capital there. It made it possible for the grain trade that Athens relied on. And so I would say there are some examples there. There are examples through time of these trading nations, these finance centers and so forth that punched above their weight, if you will, were able to become really influential societies.
Well, I'm glad you mentioned Athens, because I was going to say with the Netherlands in the 1500s, didn't you pick the single best example of a free capitalist society in all of history until modern times? But if you can trace that thread back through other empires, other trading nations, other sources of essentially self-made wealth through time, that's more interesting, because I know that one country did it once, and then the UK did it. But other than Athens, what societies that have you studied or become familiar with that have generated wealth that's sort of the right way here?
Well, think of Singapore in modern times. Yeah. What have they got going for them? It's a small city-state. It's not like we all rush out to buy consumer goods from manufactured in Singapore.
I don't have any.
Yeah. But they have know-how, and they've got a system that has turned it into one of the world's financial centers, and so that would be one example. Attempts to do that are not always successful. I don't know where we stand on Dubai as a financial center, but it certainly is something that was a vision of the modern rulers of Dubai to attract investment and capital and people and new technologies and so forth to this really small state on the Gulf. I think it's still an experiment in progress with respect to the financial dimensions of it, but certainly that is an aspiration.
Well, I think that considering that what they had to work with, which was basically an endless supply of sand and some money from the oil that was being extracted elsewhere in the Emirates, they've done great. And the fact that Dubai as a city is completely tasteless and bizarre doesn't bother me, because I don't have to go there. They're providing a service that we all benefit from, which is the ability to trade various things in the Middle East. And elsewhere.
Larry, you could have bought a house on a big frond of one of the palms, the peninsulas, and
I could I could have, but I went somewhere else, and I like it much better. I've actually been to the Emirates. Abu Dhabi. It wasn't ridiculous. It just looks like a normal city. But when I see what people are doing in Dubai, if you look on Instagram, a lot of people go to Dubai basically to have their pictures taken in front of world's tallest building or something like that. It seems like Disney World built on a much larger scale.
Yes, it's fascinating. It's a fascinating cultural phenomenon, and this notion of a vision built on attempts at new technology and inventing a nation from whole cloth is an interesting aspect of the modern world.
Oh, I know, and other people are copying. Saudi Arabia was going to build a city, I think, a mile wide and 75 miles long or something like that, with high-speed trains. I don't think that they ever built it, but it was it's nice to hear some science fiction seep its way into the line. Our host, our person who's helping us, just said, is this going to become another center of trade, commerce, wealth generation, or are they barking up the wrong tree?
That is an interesting question because, we're talking about a large physical infrastructure that, building a building that's, 100 kilometers long or something like this, that's all along a line and so forth. I mean, you can build it. Will people want to live there? But then what are they going to do when they get there? What is the economic engine that will make something that's a long stretch of properties work economically? I'm sure there's a plan. I haven't studied it. But one of the things we learned from Dubai, putting my real estate hat on for a minute, is that if you build something that is the tallest building you could imagine, if you build something that's a spectacle, and you mentioned Disneyland, that has a real power to inspire people. It gets into your imagination. You say, I would love to have my picture taken next to this. It's not a 5-star hotel. It's a 7-star hotel. It's one of the wonders of the world, right? So that's it's hard. How do you value that if you're going to put a value on it? The other thing that Dubai did is they said instead of building a Disneyland there, they were going to build something that was 10 times the size of Disneyland. Why? Because also scale is a magnet that brings people from great distances to see it, to enjoy it, to brag about the fact they've been there, and so on.
But I guess you've got your real estate hat on. I've got my urban geography hat on. And I'm thinking most of the wealth that's been created and is ever going to be created, isn't it more likely to arise in traditional cities? You just get a large pile of human capital together, which is how an economist describes a highly skilled group of people. And they're going to produce stuff that wasn't being produced before. And the physical proximity and the fact that there are amenities of all kinds. I mean, whatever a city offers is offered because the people there want it. Isn't that really a better model for development?
Yes, I can't disagree with you. This whole idea of throwing a bunch of people together and then people having their differences and different kinds of imaginations and skills and so forth, that seems to be the engine that has led to enormous amount of innovation. So this, the technical word for it is agglomeration theory. That sounds like a bunch of clay being lumped together, but I think about it as I think about London in the 1600s, 1700s, where people would go to coffee houses and they'd hang out there, and after hours they would shoot the breeze, and there were opportunities of people that the Protestants that had fled from France some of them found that these were opportunities to teach things in the coffee house, like mathematics and so forth. So these became a place where once you get gregarious people together, together they can create some new ideas. And when you look at, I mean, in the early 1700s in Britain, there's one document that I have that is really just a poster, but lists dozens and dozens of new schemes that people had to new technological schemes and so forth. I mean, they could range from new kinds of insurance on horses, insurance on marriages. They could be plantation schemes.
They could sell annuities.
Yeah,
they can ensure that you don't run out of money before you die.
Yeah, I mean, one of these was a scheme to build a flying engine in 1720. And I'm just dying to find out whose idea that was and whether the engine flew or they just raised a bunch of money and absconded.
Well, there was a 1670s or 1680s, a guy named Ferdinand Verbeest, Belgian priest, I think he was, built a car. It wasn't drivable because it was too small, so it was really more like a child's toy, but it used an heliopile, which is a very primitive steam engine, to drive an object with four wheels and some sort of steering device. And so the car was invented in 1678. We didn't have a practical one, a commercially viable one, until 1885. That's kind of a slow development line. I want to know more about this flying engine, because we certainly got flying engines by 1903, but again, that's a long wait.
Yeah.
To what do you attribute this extremely slow? I have my own ideas, but I want to hear you. This extremely slow progress of technology in certain areas that seem absolutely vital, like being able to get from one place to another without a horse?
Well, with flying, it's pretty simple. People have been watching birds forever.
Right.
And saying, boy, I'd love to be able to do that. How am I going to do it? And Leonardo da Vinci has pictures of, wings interestingly enough, Emanuel Swedenborg, who was now known as the creator of a mystical church,
yes,
that is very much based on science fiction ideas about people in other planets and so forth. But Swedenborg was started life as a passionate about engineering, lived in London for a while, and interacted with some of these early natural scientists, and actually drew up plans for a flying engine. These ideas crop up. There are legends throughout the 19th century about people that had invented the airplanes before the Wright brothers. A German inventor who lived in Texas famously had a spring driven airplane that the newspapers claimed that he could fly. And anyway,
well, there were others. I sometimes say that we think the Wright brothers were the first people to fly an airplane. All we know is that they were the first people to land one. A lot of people wanted to do the same thing. They just couldn't manage to live to tell the tale. Lilienthal, I think, died trying to fly, and maybe Langley.
Well, one of the most interesting devices found in the Greek world dates to I don't know, maybe 100 BCE, but it was a device found on the seafloor, and it's a clockwork mechanism with gears that seems to be something that is related to calendar. But when you look at it, it looks so much like a clock, and you say, well, this couldn't be the only thing that that people were making metal gear systems for.
Right.
And where did those ideas emerge? I mean, in Athens, we focus so much on sort of the philosophers and so forth. We neglect this. We neglect to think about this agglomeration theory, where it brought financing together with smart people and people that were doing different kinds of businesses and had different kinds of factories that they had created. And so that whole side of Greek life is something that doesn't quite attract classical scholarship in the way that a finance professor would love to see.
Right. Well, I mean, it's people are focused more on the literary heritage because they can find it in the library. Studying the technology is harder. But I wanted to ask you, we're studying these very early financial institutions and practices. What can we, and I think the work you've done, I do want to get to the one in southern France in the 11 or 1200s briefly, but what can we learn from this history that we can't learn from studying, say, the last 200 years, where financial data are available, they're accurate, they're right under our noses? What's the modern application of your financial archaeology?
One of the things that comes out of looking at the very long trajectory of finance is that there are a few fundamental problems that arise 500 years ago, 100 years ago, problems that arise today. And so the tools that were invented in the past, sometimes they're very different than what exists today. So one of the lessons that I take away from it is that there are solutions that emerge, but they're not permanent. They could disappear. And
give me an example of what you're talking about.
So, well, one example would be the tontine. So a tontine is a financial structure that was popular in the 1700s, particularly. It was a way of saving money, collectively saving money, and it sort of took advantage of the fact that people lived different lengths of time. So, if you were if you wanted to make sure your child was well taken care of when they retired, you would enter into a tontine with another set of investors, and you would invest some money collectively. And the way that a simple tontine would work is that all of the children of these investors would share equally in the dividends that came from the investments. So if nobody dies, you're just it's this steady form of income. But as people start to die off, you've got the same size pie, but you're slicing it with fewer slices. So if you're the last person, if you outlive all the other beneficiaries of a tontine, you're getting a huge income at the end of your life, plus a big amount of capital for your heirs when it's cashed in. So it's a little bit like the Social Security system in the United States, in that it relies on the fact that the survivors get the benefits of the money that was invested on their behalf by the non-survivors. But this tool is not a commonly used tool today in the private sector. It's got its own.
Partly it became unpopular because it was associated in people's minds, I don't know if it's even true, with people killing off members of the pool in order to get more money for themselves. There was a hilarious movie in the 60s called The Wrong Box about tontines, and if we were going to get tontines, you'd have to correct that misimpression, or maybe it's not a misimpression, but you could build the pool in a way that none of the people in it knows who else is in it, and so I think that's a promising financial service. The Research Foundation sponsored a brief written by Richard Fulmer, who said that we should have a market in tontines, and if there were one and it was reasonably priced, I might invest in it. But reasonably priced, it could be priced at zero in terms of what you pay over and above the money that goes to the beneficiaries, because it could be just a voluntary organization. The elks, the moose, the raccoon lodge could do it, but I think for prudential and regulatory purposes, it has to be done by a financial institution. Has to put its fingers in there somewhere.
The one of the things I do is collect old financial securities, both for myself, but also we've raised, when I say we, my colleague Geert Rohnhorst and I both do this together. We've gotten Yale University to also collect these things. And one thing that we've been doing is when we find an old opportunity to buy an old tontine certificate, it's a great opportunity for us because we can look at exactly how this thing worked. And one of the most important things about it is that you have to be able to verify who's still alive and who's not. How do you do that verification? If they're all spread out, they don't know each other. If they all live in different places, what's to stop somebody from saying, "Oh, my uncle died, but I'll just use his name and keep getting the money that was sent to him."
Right.
So that's
people do that with Social Security.
Yeah. You find that some tontines specify that a minister has to sign and attest that this person is still alive. So you still need a verification mechanism, assuming that all the ministers are honest and they don't have, so it's got these problems that you have to solve.
Right.
Just as you say, Social Security fraud is also something that exists.
And any financial arrangement that moves money across time and place is going to face the same problem. Look at credit cards. What percentage of all credit card charges are fraudulent? It's got to be in the single digits. It's not a fraction of a percent. So we've got these mechanisms, but one of the mechanisms is restitution. You just put up with it, and then the issuer builds into their fees a certain amount of money for paying you back if you're ripped off.
Yeah. Just the frictions of the system.
That's right. And so you're not just a financial archaeologist, you're a financial lubricator. You provide some oil, so it's kind of what Wall Street says they are. We provide the oil and grease. I mentioned earlier a company in southern France in the Middle Ages, but before I go to the last topic, which is the project you're doing with Roger Ibbotson, could you spend a few minutes telling me about this company and what is special about it? What did they do for a living? What is it?
Well, the story does involve Roger Ibbotson, and it might even involve you. Now we're going back. You and I have known each other since the 1980s. That's right. And Roger was the person that put us together. And so we've been talking about interesting financial subjects from that day till this. But Roger once mentioned to me when I was saying I was interested in the first stock market and the first stocks. He goes, "I think there was something about an old mill in southern France in the Middle Ages." And I said, "Well, can you tell me more?" He goes, "No, I just heard it somewhere." And that was that. I mean, this was in the time before the internet. Okay. So I had a hard time trying to track that hint down. But then when the internet came along, I started to look and I found some evidence exactly so. That there was a wonderful old book written in 1955 by a French historian who studied these mill companies in Toulouse that were founded in the 1370s. So I found the book. Matter of fact, I had to send away for the book. Then I was lucky that I had some high school French, so I could appreciate the book. And I got fascinated by it. And so one time when I was in Europe, and actually I had trouble getting a flight back to the United States, I decided just to go to Toulouse and look at this mill. And sure enough, there is a mill building in Toulouse that was it was where the mills were operating for grinding grain, and it's called Beinecke, the Beinecke. While I was there, I met a colleague, a finance professor, who said, "Oh yeah, I know about this place. Let's go take a look." And then it turns out the author of that book was still alive, and so he and another colleague of mine who's also a professor in Toulouse, the two of them were able to interview him, and I was able to get the book translated. And so this really opened up a wonderful field of study about one of the earliest, well, not just one, but several of the earliest equity investments that you could have been making in history. I know we talked about
Before that, we thought it was in the 1600s, and now you brought it back to the 1300s in one jump. I mean, the history you learned in school is the joint stock company started with the Dutch East India Company around 1600, isn't it?
Yeah, that is the dominant, let's call it a dominant narrative about the origins of modern corporations. Yeah. That they were invented by the Dutch, were really Dutch and English both, were using these things that were like corporations. But why did they have them? Well, it's because doing the spice trade required almost permanent capital in a company, and you had to be able to lay off the risk to many people, so you needed a lot of investors. There's a story you can tell about why equity investment and a stock exchanges emerged in these trading nations that did these great long voyages. But when we came along and said, here are some companies that are not doing long distance trade, they're almost like infrastructure companies in that they were mills, important mills. I mean, they're not small companies, right? But it was a steady Eddie kind of business. I mean, sometimes there were famines and stuff. There was risk, but it had a very different origin story. And yet it was a corporate structure that is very much like modern corporations. And when I say that, I mean, there were diverse shareholders. They could trade their shares. There was a limited liability, so that, if you had the right to just to hand the share back to the company if you didn't want to pay money that they asked you to pay. And then it had a board structure, staggered governance board. It had a separate auditing function. I mean, you just tick through what a modern company is, and this thing is so much like them, much more so than the Dutch and East India companies. So this is a narrative that is quite contrary to the origin story of the modern corporation, but it bears interesting analysis because, corporations, the corporate form is an equilibrium. You have investors, you have entrepreneurs, and one side needs money, the other side has money to give. But you have to have a system of checks and balances that promises the investors they're not going to get ripped off, And you also have to have a system that incentivizes the entrepreneurs. And the corporate form has developed to facilitate that, to make that possible. And so, if you're a finance professor, you can get excited about theory and what is an equilibrium amongst the number of people with disparate interests, and is there an incentive compatibility that you could design so that people are willingly participating in this deal.
Right.
And so in the Toulouse mill companies, it was certainly true that this corporate equilibrium emerged, and it might have just emerged in a completely different economic setting when it came to these long distance voyages to Southeast Asia, which the Dutch and English East India companies were doing.
Right. Well, of course, you've traced the corporate form back to at least ancient Rome, not just classical Toulouse, France. So that obviously is a topic for another day, how to draw a thread that connects Rome, medieval Europe, and then the modern corporation, which emerged probably around 1600. Although I guess you're saying that the classical corporation was more modern than the Dutch East India Company in terms of its correlation with what we use today as a corporate form. Let's go forward. We have about 7 or 8 more minutes. I understand that you're working on something with your friend and mine, Roger Ibbotson, who gave me my first professional job. I was his student, and it's the common practice among finance professors is to hire the best student they've got who can't get a job, and start a little company with him.
Well, you remember when I was working with the Ibbotson Associates too, so
I do. Yes. Well, I maybe you fit the same description, but I doubt it. What are you doing with Roger, and how does it relate to what the Research Foundation is hoping to do?
Yes, well, Roger's very well known for being a financial archaeologist himself, in the sense that he, early on in his career, got interested in estimating the long-term rates of return for stocks and bonds and treasury bills, and then comparing those to the rates of inflation. And long-term, when he started doing it, which was back in the 70s, meant the 50 years of financial data that existed in the United States that was reasonable to use back to 1926. So out of that, his company emerged out of that effort, but he kept he updated a study over decades of the stocks and bonds and bills and inflation, the rates of return. And those have become the go-to source of information about calculating things like the equity risk premium. So how much do I expect that stocks will return over treasury bills over the next 50 years? And so, every time the stock market goes up or down over long stretches of time, this number will change a bit. And Roger's company for years maintained that database. So we're coming up on the 50th anniversary of the publication of Roger's 2 papers that are drawn from that data work, both of them with Rex Singfeld. And one of them is about looking at the past and seeing what the rates of return were, and drawing inferences about the equity premium and we call it the horizon premium, which is the return of long-term bonds over short term and so on. But the second,
I'm sorry.
Yeah.
The underlying question is, what's the price of risk? How much do people have to be paid in order to get them to take risk? And of course, this is the basis of all asset allocation, financial planning, corporate finance. It has influenced almost every aspect of financial thinking and practice. So what are
So
you
there,
doing now?
you're speaking as a theorist, and I appreciate that, which is, why should the rate of return be some number? Why can't it be 50%? Why can't it be 2%? Well, because it's set by the demand it's set by the required rate of return for taking that risk. And so it wasn't just the returns he was calculating, but as you point out, it's the risk as well.
We were speaking about Roger Ibbotson's stocks, bonds, bills, and inflation study. The fact that it has a 100th anniversary coming up, 50th anniversary of the study, 100th anniversary of the starting date in 1926. And then we were talking about the theory underlying why we would care what those rates of return were. Could you bring us up to date on what you're doing now that might be used, say, by the 100th anniversary?
Well, happy to. Yeah. Absolutely. Well, first of all, what we want to do is make sure that we can keep this this data collection effort going, and then for the anniversary of these early publications, what we're going to do is test to see whether or not the predictions that were implied by Roger's early research are validated by 50 years hence.
As I remember, the predictions were pretty good.
They're pretty good for stocks. Yes. So the equity premium is very close. The 50 years after his study with Rex Sinquefield, the equity premium is almost the same as the premium was from 1926 to 1974. That's remarkable. Yeah. Now, what's different? Bonds are completely different. Bonds reached their peak like in terms of yields in 1981 or 2, something like that. And
80,
then
81, yeah.
Yeah.
I had a mortgage. At 28 years old, I had a mortgage of 13 3/8, and I thought it was a fabulous deal because they were going over 15.
So if you've been an astute investor and prescient investor, let's say astute. If you were a prescient investor and you knew that bonds would start, yields would drop over the next 30 years, well, my goodness, that means the prices would go up. You could have the rates of return on bonds were really high compared to historical evidence. So that's an interesting phenomenon as well. It tells you, look, when you have investments that have long-term cyclical or secular trends, like interest rates or things that are exposed to inflation, you can't just, it takes some extra work to make forecasts about what the rates of return might be. And some of that work is what Roger and Rex did in their forecasting paper.
So what can we expect in 2026 out of not if I don't expect you to make a forecast, but what kind of work do you think is going to come out of your research around the time of this 50th/100th anniversary?
Well, we would just love to have an anniversary volume along the same lines as the kinds of volumes that Roger and his company produced over the years, with the guides that are in those volumes about how to calculate the equity premium, how to calculate all these premia, and then how to interpret them, but also the indexes and the data that people are that CFAs will be able to refer to going forward. So the data plus the algebraic tools on how to use it, that's something we would like to publish.
Well, it sounds great, and as I'm sure you know, I've volunteered to help shepherd that through the Research Foundation. If if that's what's needed, but I don't think it's needed. I think we're all agreed that needs to be done and will be done. I just want to close first by thanking you, but also by telling a silly story. My first job when I started working for Roger in 1979 was to help collect data for stocks, bonds, bills, and inflation. And now it looks like it may also be my last one. So it came back, and it'll be really fun to work on it if that's what happens. Well, you've given us an education today, a liberal arts education in finance that I hope is appreciated by our wonderful audience. Thanks again.
It's been delightful, so thanks for the opportunity.
Talk to you soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.